Welcome, everyone. Thank you for joining us today. My name is Andy Allen. I'm with Timuron Partners, TPI. We have sponsored this webinar series with our valued partners, Bridgepoint Advisors. And with that, I will turn it over to the Bridgepoint people to introduce themselves and to get the webinar series started. Thank you for joining.
Great. Thank you, Andy. And thanks to all of our friends at TPI. We are really excited to embark on this with y'all. So greetings, everybody. Thank you for sharing a little bit of your day with us today. Just a couple of housekeeping things. You should be on mute. If you've got questions on anything, you should be able to put them in the chat, but certainly you can email anybody on the TPI team, and we're also going to have our contact information in the very last slide. So if you're already a TPI partner, you likely know that it is a strong focus of theirs to provide as many resources to you as possible to help into your success. So this Building a High Valued Company series is just another way that they are working to provide you additional education and resources. So myself, I'm Kelly Bond, my partners, Steve Rubin and Jason Greeley, and I are going to be presenting for these next 3 webinars. And we are excited to have you here and hope you'll join us on the next couple. So Jason, I'm going to hand it over to you to talk a little bit about us.
Well, good morning, everyone. Yeah, just a little bit about Bridgepoint Advisors. As Kelly said, it's myself, Jason Greeley, Kelly Bond, and Steve Rubin. We are mergers and acquisitions advisors to the alarm and integration companies, as well as central stations. We work mainly with sellers, but we do represent a number of buyers as well. We have over 100 years of combined experience, with Kelly and myself closing in on 30 years and Steve having about 40, which is surprising for 3 spring chickens like ourselves to have that kind of experience. But the majority of our careers we have spent working with dealers, both in finance and in the M&A space. We've closed several hundred transactions, and as long as we have been doing this, we still learn something new on every transaction we handle. After close, almost every dealer tells us that they never knew as much about their own company as they did after going through the sale process. So the reason we do these webinars and training sessions is to try and share things that we have learned over the years to help dealers across the country build successful businesses. Most of the things we will discuss in this series are better business practices that will not only help you build value in your business when you go to sell, but also should help you with operations and profitability today. So with that, let's get started.
Okay, so this is what we're going to jump into today. We're going to talk a little bit about what's happening in the market and who's buying and selling, because we know that everyone wants to know about that. We're going to jump into the different business models that we see and who we're generally working with. We're going to talk about recurring monthly revenue and the things that impact the value of that. We'll spend a little time on financial reporting and how important that is in your business. We'll talk about a different type of business than RMR. It's your business is valued by your revenue, and it's EBITDA, which we'll go through that term. We're going to talk a little bit about your team, and then we will focus on the sellability of your company. So I am going to hand it over to Steve to start us off on what's happening in our space.
Thanks, Kelly, and good morning, everyone. Appreciate the opportunity to be able to spend this hour with you. So first, I'd like to spend a little bit of time discussing who is selling, why they're selling, what does the business look like, where are they located generally, and then what the buyers look like, what type of buyers are there out there now. So I'll start out with who is selling, and there's various categories. One is people who, and especially now, there's a lot of company owners that are in their 60s, 70s, and they have been around for a long, long time. And they are looking now to cash in. And so with that, they go out and they start talking to different people about the potential for selling. But then they realize a few things. Number one, is it time to retire? And the big question is, if it is time to retire and enjoy the rest of my life with my family, then how do I do this? And so the first thing that comes to mind in some companies, with some company owners, is that they have family and possibly family in the business, a son, a daughter, who may or may not want to take over the business. If they do want to take over the business, then there's a lot that has to be considered there. And we always, especially when the companies come to us, these dealers come to us and say, what do we do? I'm going to hire you guys to help me through a merger and acquisition transaction. And the first thing we tell them is, with a family member, please be very careful. We have seen it all. We have seen a son or daughter take over, and within a relatively short period of time, the ex-owner recognizes that the business is going downhill. They have to come back in and not where they want to be at this point. Number two, who knows what happens? There could be a lawsuit that's created between a son, daughter, and a father or mother, and you just don't want those types of situations. Certainly, if you are selling to one of your kids or a family member, you want to make sure that there's a contract that's between you, and get a good industry attorney to help you with that contract, so that if anything does happen, at least there's some law behind it. I mean, it all could turn out fantastic, but we have seen some that have not. So that's one. So think clearly before you do anything like that. Number two, companies that are needing, you're in a position where you need funds because you may not have been growing the company or running the company as astute as you should. You're a family organization. It's a small to medium-sized company. Your books are not, your financials are not exactly the way that they should be. And all of a sudden you see, I need money if I want to keep going. And so that's a decision. If you decide that you do want to keep going, there are avenues for you. There's a couple of companies in the industry who specialize in loans to small businesses. If you go to banks, your interest rates are astronomical, and they may not be the best avenue. So if you get into a position that you are in where you do need funds to grow your business, or to stay in business, in all these areas, I'm going to say it once and I won't say it again. In all these areas, we could certainly help you, go into the right direction. Another area is if you've grown to a certain level, and now you want to get to the next level. Say you want to bring on some more technicians, you want to bring on some more salespeople, you want to develop a new software program, and that takes money and time and effort. And so at this point, if you don't have the money, if the dealer doesn't have the money, then they've got to go out and they've got to make a decision. Do I borrow money to accomplish this? Or is it time, if I've been in business long enough, if I'm satisfied with where the business is it time to sell to a larger company and keep the business going as always? So that could be an option. Also, we see what others are getting out there. And if you've seen the likes of Pi Barker, if you're familiar with these names, Pi Barker and uh, uh, API, Trivest, and others that are buying, the multiples are extremely high. Everything's attractive. These are good companies, so that could be an option. Many of these companies never thought they were going to sell, but when these dollars are put in front of them, they look at it and say, maybe it's time for me. And last, you just want to be part of a bigger picture. And so you look at that and say, if I can get into the same thing that they're doing by working for them and helping them to grow the organization, this is something that I would like to do. And I could cash in, keep my money, keep the company going. It's a great option. What does the business look like? Um, First of all, the ripest for the buyers are dealers who are in great markets. They've built a great team. Their financials are in order, good profitability, good amount of RMR. And we always look at all types of companies. Many buyers are already in the market, and adding the business would be a natural add-on to their existing business. As far as location is concerned, it's everywhere across the country. Obviously, in major markets is where they would like to be, but certainly in other markets, if they can be a prime player, then that's a big thing. And then what does the buyer look like? They could be a local company trying to knock out their competition. It could be a regional company moving into strong local markets to build regional presence. Then they could be a national company buying everywhere. And their game plan, most likely with some of these, are to go public. The investors are looking for, there are investors who are from other industries looking at our industry. RMR is extremely attractive. Private equity companies are looking for more avenues, and they see this industry as a very growth industry. Moving on to business models, excuse me, there are RMR models, recurring monthly revenue models. We love RMR companies. And if that's what they're selling more than anything else, there's tons of buyers out there who are looking to buy RMR and just add RMR to their business. These days, there are lots of companies who are buying based on the integrators. And that means commercial integration, emphasizing a lot on fire, but certainly other things. And as long as the seller has built a very good team, financials in order, good profitability, good amount of RMR, that's what the buyers are looking at more than anything else. They're located everywhere. It wasn't too long ago that if a seller wanted to sell, unless he or she was in a major market, as I said before, then there wouldn't be many buyers. But if a buyer is based on RMR, then a particular multiple is attached to it, and that becomes the buying price. Kelly will be diving into more during one of her upcoming slides. The other way of purchasing is based on EBITDA. And over the years, the acronym EBITDA became the new buzzword in our industry. That's earnings before interest, taxes, depreciation, and amortization. And more buyers are buying based on that than anything else. Your P&L statements always have a bottom line, net income, and that net income added to all expenses that are incurred on the P&L that will not be repeated when a new buyer takes over, which is like a vehicle that you may own that is being paid for through the business, but once the buyer takes over, if they're not taking that expense, then that goes to the bottom line, and several other things, such as a salary that won't be continuing. All of that goes to the bottom line. And that gets added to interest, taxes, depreciation, amortization, and the net income. And that's called adjusted EBITDA. You probably all know this, but then the adjusted EBITDA number is multiplied by a particular number. And that number becomes the buying price. Again, more from Kelly on this as well. And then the last thing is just a hybrid company. And they're very strong when they are a big RMR company and they're a very profitable company. This is what the buyers like to see more than anything else. And as I said before, it used to be where residential was a big thing. Now residential is not. Commercially oriented companies is where the buyers like to be. So that's really the summation of both who is selling and the business models. Kelly?
Okay. Jason, can you see? We're having some issues with slides. I apologize. Jason, can you see the next slide? You're muted, and I'll reshare.
Okay. Did I break the machine?
Yeah, go ahead, Jason, though. I'll get caught up to you.
So as Steve had said, the buyers are looking at deals. They're looking at companies both on an RMR basis or an EBITDA basis. EBITDA is somewhat new, at least in the integration space. RMR is what we dealt with for the last 25 or 30 years. But there's several factors that buyers look at when they're looking at a business on an RMR basis. They're looking at the mix of commercial versus residential. As Steve had mentioned a minute ago, right now, commercial and fire is a little more desirable than the residential space. That being said, we still do residential deals and have buyers for those, and we sell them all day long. But clearly, the focus from the majority of the buyers we're dealing with right now is on the commercial side. One thing they look at is recurring revenue versus project-based revenue. And what we see is value in having a good mix. And recurring revenue will be contracted services such as Berg and fire and CCTV and things of that nature, and not just the installation and project-based revenue. It helps steady a business, and the financials come out more on an even basis, month in and month out, versus project, which may go a month or two with not much income being shown and then balloon to a tremendous month. So the more of the contracted recurring revenue that a company has, the better. Buyers are now looking closer at margins on the companies. Are they making money not only on their recurring services, but on the upfront installation products that they're selling, and what does that look like? And that's clearly a factor of what they're putting into the offers that they are giving us for companies is what is the profitability and the margins that they can expect from this business. They're looking at the contract terms and language on the recurring revenue. For it to be eligible, it needs to have a agreement in place. It needs to have language in there that helps protect them from a liability standpoint, helps to indemnify them should any incidents occur. It needs to have a term, 1-year term, 3-year term, 5-year term. That varies a little bit on the valuation. There are buyers that will pay a little bit of a bonus for a longer term contract, and there are buyers that'll reduce if it's less than a 3-year. But for the most part, we don't see a ton of difference in the various contract lengths just from what we have seen. But there definitely does need to be a contract in place with protective language for the company, for the buyer to buy it. A lot of the banks that lend to our industry are going to require that in order to lend to that buyer for a potential transaction. Another thing that's looked at heavily and right up front is the attrition or cancellation percentage on a customer base. And I'll get into that in a little more depth here in a couple of slides, but the attrition rate on a company is something that buyers look at immediately before they'll ever make an offer. Customer concentration, they really want to see that the RMR or the revenue is being generated from a lot of customers and not just concentrated into a couple. And that's from a protection standpoint. If they're buying a company and half of the revenue is generated from one key client, that potentially is an issue for them if that key client were to go away. So they really want to see the revenue spread out over as many different customers as possible. And then lastly, they look at from a valuation standpoint are the billing practices. They will look at what percentage of the customer base is being billed with automatic draft or credit card versus a statement bill. Frankly, the more the customers that are signed up under ACH or credit card, the better. It's a more stable account base for the buyer, and so they definitely will see that as a bonus if that's the case. And then lastly, they will look at the aging of the account base. For years and years, anything over 90 days past due was typically ineligible. More and more buyers are actually moving that to a 60-day standpoint for it to be an eligible account. So that's one thing that you really want to stay on top of and look at is what does your aging look like in your billing system. So on to the next.
Did it move?
It did not, but
Okay, I'll reshare.
yeah, that'd be great. So we're going to talk a little bit about RMR opportunities. A lot of the integration companies that have gotten into doing access control and CCTV and test and inspect and maintenance services, some have gotten out of the habit of trying to get RMR, recurring monthly revenue, and get a contract for that. And if that's the case, I would encourage you to make that a priority, put that back on the table. These are customers you are dealing with, and frankly, the more different areas that you can work with for that customer to have a single point of contact, the better. So certainly I would encourage you, if you are going into a job and doing access control, see who's doing their alarm system, and whether it's a Berg system or a fire system, there's a need for that. And try and sign that customer up on a burglar alarm contract. If it's a commercial company, maybe fire alarm system, and getting monitoring agreement in place. If you're able to do that, not only can you make money off of the customer for the installation work that you're doing on the front end, but you can then sign them up on a monthly agreement where you're getting 30, 40, up to $100 on fire system on a monthly basis. It's really going to help the financials when you go to sell and make for a more stable base. Fire systems have test and inspection. There are companies that will do that just on an annual bill, and they bill for those services as they do them. We would encourage you actually to make that part of the monitoring agreement and put test and inspect on there as a contracted service that you provide. The multiples that buyers are paying for these various services may vary. You may have a multiple in the 30s or 40s for Berg and fire systems, and not the same multiple for test and inspect, but there's still something there. And it's based on the margins for each of these different aspects. Excuse me. So I would encourage dealers to get that contracted and not just do that on an as they go basis. Cloud access and video, that's another one that a lot of companies will provide that service. but not necessarily get it under a monitoring agreement. And if there's a monthly service, whether it's for hosting or servicing of those services, I would encourage you to do that. And when we talk about multiples, what we're talking about are months of revenue that are paid out in advance. So if we say 35 multiple, the buyer is paying basically 35 months of revenue out into the future for that service. And again, those multiples may vary a little bit by the service because they don't have the same margin on them. But if a buyer is looking at a company and they have all of these various services, they can come up with a multiple for each bucket of revenue that's being generated by the seller. Service only, what I'm talking about on that is basically maintenance. A lot of companies will provide a maintenance for the customer. Hopefully that's just a 1-year warranty that they are providing. If the dealer is in the habit of providing, let's say, lifetime service, that is definitely, it may be a positive from a selling standpoint, but that is a liability that a buyer is going to have to look at and adjust for if they are taking that on. What I would encourage a dealer to do is add service to the agreement and make sure they're making money off of it. If it's $10 or $15 a month and there is a trip charge for that, that is something that, again, can get a multiple when you go to sell versus just billing for that as you provide the service, which sometimes that's difficult to get a valuation from a buyer on if that's the way you're doing it. And then lastly, what is eligible RMR? So typically in this day and age, eligible accounts would be accounts that are on a monitoring agreement, as we've talked about. They are providing a signal to the central station if it's something that is being monitored. More buyers are getting conscious of wanting to make sure that the accounts are communicating with the central station that is monitoring them and have sent a signal within at least, let's say, the last 6 months. And also, where are they on an aging basis? To be an eligible account, they typically are going to want the aging to be at least 60 days past due or better, so past 30 or current, for it to be an eligible account. If it's not eligible, it's not uncommon to have a pool of accounts that were not eligible for the initial sale, but the dealer can fix the issue and make sure it's eligible and do a secondary sale at some point down the road. And so the last thing I will go into is an overview of attrition. So we got a reboot for that as well. So in talking about attrition, what buyers will look at is gross and net attrition. What is not uncommon is for the buyer to initially get a report either from the billing system of the dealer or from their central station, or a combination of both. If they get it from the central station, they will largely get what is called an add delete report. That report will go back typically 12 months, sometimes longer to 24 months, and will track on a monthly basis how many accounts is the dealer losing per month and how many accounts is that dealer adding per month. Depending on what type of sale it is, a buyer may look more closely at one of these versus the other. For example, if the buyer is simply buying accounts, they will largely look at gross attrition, which is the cancellations over the reporting period, whether it's 12 months or 24. They are buying a static pool of accounts, whether it's 500 accounts or 1,000 accounts. They want to see at what rate or what percentage is this base that they are buying attriting or canceling. And I can assure you that an account base that is canceling at 8% annually is going to have a higher value than an account base that is attriting at 15, 16, 17%. So that's something to pay attention to. Net attrition is going to add back the additions or new installs or moves that a company is putting on each month. And if a buyer is buying the entire company, they will look at this just to see, is this company growing or are they shrinking? Are they outpacing their cancellations with their new sales every month to grow this company? Are they staying stagnant or are they actually losing on a monthly basis? So that's something that buyers will look at depending on the type of transaction this is. When we'd spoken earlier about things that we're talking about that will add value to the business today, as well as potentially help you with your operations, I want to go into a few items that a lot of dealers simply overlook. Most dealers are so focused on sales and adding new accounts and adding revenue that they really don't pay attention to their cancellations and track them and even have a good idea of what their attrition rate is. And what's common for us to see is buyers or sellers will get ready to sell. And at that point, they will suddenly say, okay, I need to look at my central station and look at my billing and clean it up. The problem with that is they will suddenly then cancel a lot of accounts that maybe should have been canceled 12 months ago, 15 months ago, 2 years ago. And if a buyer asks for one of these reports, it doesn't look good from a first look perspective because the dealer has recently done a cleanup effort. So I would encourage everyone to track your cancellations every single month, pay attention to this. And I would even encourage companies to have a key person to work with cancellations and have a process for that, so that if a customer were to call in and cancel, there is one person, hopefully somebody with a great personality and customer service oriented, that can speak to that customer, find out what the issue is, and potentially have the tools to try and retain them. Because it's much easier to try and keep a customer than to generate a new sale or create a new customer. So have one person that's in charge of that can hopefully try and save them. To the extent they cannot, have a process there for what that will then look like. They will cancel them out of the billing system. They will cancel them out of the central station. They will cancel them out of alarm.com or whatever communication source they are using. They'll take them out of the file cabinet if it's paper contracts, or pull them out of their electronic file if that's the way they're keeping them. But there should be a process in place to close these customers out. The most recent sale I had, we were working with a dealer that did a great job of canceling out of the billing system, a great job of canceling out of the central station, but we're completely forgetting to cancel out of alarm.com. And it wasn't until we got into diligence that they realized that there were about 75 accounts that they simply had not canceled out of alarm.com. In this case, it really did not affect the attrition. However, it was over $500 a month that dealer had been spending on alarm.com fees on customers that had canceled 6 months ago, 2 years ago, really costing them a tremendous amount of value or money on a monthly basis. And so the question is, does this impact your value? And the answer is yes. Buyers are going to look at your attrition rate and definitely will change not only purchase price, but probably the terms of your transaction, depending on what your attrition rate is. It's not uncommon to have a holdback period of 12 months or so. 10% is kind of an industry standard. And if your attrition is below 10%, that would make sense. But if you're running above that, you're going to typically have a higher holdback, which is less money you're going to receive on the front end. So definitely pay attention to your attrition, begin tracking it. It will benefit you today, and I assure you it will benefit you when you do go to market.
Okay, before I start, can you see the financial reporting slide? Okay. All right, I'm going to stop sharing. I don't know what is happening today, but we're going to reshare. And while I am trying to do two things at once, just have a really quick comment on something that Jason was talking about. going through that process of making sure that you've gone through all the steps of removing a customer. I know a lot of companies will keep an account in their billing system and they'll let it sit in aging so that they do not forget to bill them or keep them in collections. And just be really careful doing this. You need to flag those accounts, because one of the things that you should be looking at frequently is an aging report, like Jason was just saying. And if you are seeing you've got a bunch of accounts in there over 120 days or longer, a buyer looks at that and they may absolutely freak out to see that you've got these accounts sitting in there. So just make sure you're taking all the steps to clean up all of those closed out customers. Okay, so we're going to talk a little bit about financial reporting. And I can't see you, so I can't see if you're shaking your head or raising your hand or anything. But what I want to know is how many of you are really familiar with and are running financial reports and really looking at them on a month over month basis, or even more frequently, at least referring to them. This is the bread and butter of your company. This is the snapshot. These matter because you should have complete confidence in your numbers. And the financial reports are what share that information, not only with you, but with investors. If you've got a board, they want to look at that. Or if it's just you and a single partner, you want to have this snapshot all the time. I'm going to tell you a really quick story about a company that I was working with a couple of years ago that was ready to sell. They were a company that their value was based on their EBITDA, which I'm going to talk a little bit more about in a minute. But so how we start the process is looking at 3 years of financial statements. So they sent me their balance sheets and their P&Ls, and I reviewed everything on them and plugged them into a report, which I'll show on the next slide, and started to come up with what their net income numbers are and looking at their cost of goods sold and all those things. And I see a couple of years in miscellaneous expenses, and they were about $6,000 or $7,000. And then all of a sudden I see a year where they are $780,000 in miscellaneous expenses. So I'm on a Zoom call with the seller and we start going through these, and I'm sharing my screen and he can see what I am seeing. And I said, hey, listen, this probably just got misreported or, should have been somewhere else in your P&L, but take a look at this number. And I get a blank face. He has no idea what he's looking at. He does not know where that number is coming from. So we agree that he's going to go and do some homework and we're going to get back together. And about a week later, he called me and said, we've got to put everything on hold. We had a controller working for us that apparently opened a credit card in our company name and has been paying the credit card through the company's miscellaneous. And this person no longer works with us, and they, obviously there had been embezzlement happening. So this is just one of many, many stories where owners were not paying close attention to their financial reports. If you get them and you don't look at them that often and you don't feel like you have a really good understanding because maybe you have an outside source that's providing them to you, go on YouTube and search some really basic instructional videos on how to understand financial reports. There are so many different sources for you. Many years ago, I read this book called Financials from the Lemonade Stand. And that's how I really started to learn what I was looking at in financial reports. But as advisors, this is the first thing we look at. And this is what we're using as the source to see where the value is in your company. So look through your statements. Definitely, if you want to do a snapshot, and by the way, I will throw this out there now. We're going to follow up with you with an email, but we are offering a free valuation for anyone that is on these webinars. And so what we're going to ask of you are 3 years of financial reports. If you're a company that is, your value is based on your EBITDA. So make sure that you understand the reports and then look for that bottom line, that net income number, because that's the number that everything kind of builds from. So I'm going to assume that you cannot see the slide that I just moved into. So I am just going to reshare because I want you to be able to see it. Okay. Jason, are you able to see core valuation drivers? EBITDA.
I am not. I am
No,
not.
You're not. Okay. Well, I'm going to start talking a little bit about this. See if I can get this to share. Okay.
There
How
you go.
about now? Okay,
Yep.
great. All right. So like I just talked about, you got to have clean financials for us to come up with a really good valuation for you. And this model that you see on here, I know the numbers are small and you don't know where they're all coming from. But if we do a valuation with someone, we have a model that looks very, very similar to this. We start out with their revenue. We look at their cost of goods sold. We understand what their growth looks like year over year. We look at their profit and what their margins are. And then we look at the net income. And from there, that's where we are starting to build the value of the business and understanding what, when we take it to market, it looks like. But this is a number that you should have all the time. You should be able to understand where your value comes from at any given time. And that's why we are offering up the, no cost valuation, no commitment or anything else. We just want to give you that resource that you can keep following up with yourself. So we're also, Steve mentioned a little bit earlier, talking about add backs or adjustments. And as he talked about, I won't give you the whole definition of EBITDA again, but we are looking for interest, depreciation, amortization, and certain taxes. So not all taxes can be adjusted off of your net income to come up with your EBITDA, but certain taxes. Then we're starting to look at things, your adjustments or your add backs, like he mentioned. That could be, for example, if you've got your whole family's health insurance that you're paying through the business, well, the time you sell, that's going to go away. So that's a number that would be added back in. These are fees that will go away once the business is sold. So you may see that I've got owner salaries listed here. Sometimes the owners are going away and they may have a management team in place so that they do not need to be replaced. If that's the case, then we will add their salaries back and it becomes an adjustment. Some other things that you want to make sure that you're looking at. Maybe you had a one-time legal issue and you don't expect to have that again. It just happened that 1 year and it was a big number. By all means, we would include that as an adjustment or an add back. Let's say you did a purchase of a bucket truck and you paid for it in cash upfront, one-time purchase, that's something that can be added back in. It would only show up on your financials one time. So these are things that you want to pay attention to. I also want to tell you just another really quick story. It's not even the story so much as it is an occurrence. I was working with a company last year that was getting ready to sell. There were two partners and they used their business credit card for everything. They could drive through McDonald's twice a day for a Coke and they would put it on the company card. They had a membership to a country club where they took clients out because of the nature of their business. They did a lot of client entertaining. They had a skybox at their stadium that they did a lot of entertaining. Unfortunately, they had not separated the personal expenses, those Cokes through the drive-through, and the actual entertainment of customers. They just had a number of $425,000. That's a problem. You need to separate those. You need to understand what your operating expenses are versus your just personal expenses. And we don't care. We don't care if you bought a yacht and put it through the company, but we have to be able to document it. You should be documenting it because these are costs that really will truly go away. But if you need to entertain customers to keep them as customers, those costs will not go away. So that just gives you a bit of an idea of what are some of the adjustments and what you need to know as far as looking at your financials as your valuation drivers. Okay, I'm going to try to make it to this next slide and see. Do I need to reshare for management and owner?
it's not on there.
Okay, all right. So Steve, this is you. If you want to go ahead and start, I'll reshare now.
Okay. So first of all, I want to mention what Jason and Kelly went through are like diamonds for your business. I listened very carefully to everything that they said, and hopefully you did as well. And hopefully, because this is being recorded, you'll be able to go back and listen to some of it again. But I'm sort of like the icing on the cake, but their information is absolutely priceless. So to finish this off, we're going to talk about a few areas. One is management and owners. And what we're looking at here is really what it's going to take for these buyers to look at a company and say, this is an A++ type company. And so we're going to discuss a little bit about strong leadership, reduced owner dependency in daily decision making, incentivized management team willing to stay post-transaction, which is something that we're not sure of here, and your organization chart and accountability for each individual within your company. So first off, management or your ownership. And the question is, how do you rate yourself as an owner and as a manager? Kelly mentioned about knowing how to read P&Ls and balance sheets. When I first got into this business, I had absolutely no idea how to do this. And yet I was supposedly in the M&A world. These buyers live, eat, breathe on the P&Ls and what they see. And so all I'm going to emphasize again, you better know that stuff. We worked, there's a company that we worked with out in the Chicago area, which is where I am. And you may have heard of them from before, a company called P1, which sold to or merged into and sold to ADT eventually. And the owner of the company, the manager of the company was Tim Wall. I was friends with him. I used to come to his office quite a bit. We used to have lunch together. And one thing that he did, which was I marveled at, was that someone would bring into his office one piece of paper and leave it on his desk every single morning. And it was the summary of what happened the day before. And he had it by departments. And so each department had their own little, what did we do and how did we do it? And he looked at that and he was able to determine, was yesterday a good day for my, this end of the business? Was yesterday a good day for another end of the business? And it could have been administration, it could have been sales, marketing, management, operations, finance. And by the way he structured it, he was able to tell who he needed to talk with, who he needed to bring in and have a discussion with about what are you going to do about this so it doesn't happen again tomorrow. And it was a great device. He never was harsh. He just wanted to make sure that things were going in the right direction. And he wanted to catch it, not on a monthly basis, but he wanted to catch it on a daily basis. A lot of company owners, can't do that. They're not set up that way. But at least on a weekly or at least on a monthly basis, you should have a reporting system where you can catch things that are happening before it gets to be, dangerous for your company. I will say this. It's hard to build a strong leadership team in all divisions within your company. When you first started, it was you, and maybe you and your spouse or a partner, and you did everything. You managed, you sold, you installed, you did the financial end of the business, everything. As your company grew and you wanted to succeed past a small organization, you needed to bring others in. And this is where the business, either succeeds or doesn't succeed mainly, and that is bringing in good, solid people to run different departments within your company. The two major ones are the sales department and the technical department. And if you can do that, you could then be more of a visionary building past this small organization into maybe a medium-sized organization or a growth organization. And that necessitates building that strong team. You want to make sure that you reduce your owner dependency in all of the daily decision-making processes. When a buyer comes in, they certainly don't want to see a situation where you are just about everything. And so they look at it and say, okay, if you're going to leave or you're going to retire or you're going to stay for a short period of time, and you are the contact of all for all these subscribers out there, the potential buyers will not pay top dollar for your company because they realize they're going to have to replace you and bring on salespeople, etc. So if they have to figure out how your subscribers will be taken care of properly, they may even choose to walk away. So make it reduced owners, the dependence on you and more on your employees, and build a strong management team. The next one, incentivize management team willing to stay post-transaction. We don't like that. We don't like having to tell anyone within your organization that you're selling. Now, the practicality is that if you've built a company so that your management team is running everything, and you truly can't get to the software programs, can't get to the financial statements, can't get to certain things that the buyers are going to be asking for. And believe me, if they're going to plunk down $1 million or $10 million or whatever it is for your organization, they're going to want to dig into every single division or every single department within your company in detail. And so it's a double-edged sword. You probably do need somebody, a trusted employee who knows the financial end of your business, to work with you on this transaction. However, the danger, be careful. You could be telling somebody that goes ahead and tells somebody else. And that could be the reckoning. I mean, this could be the difference between making a transaction happening and possibly even, losing your company. So and I could tell you stories, I'm not going to because we don't have the time to do so, but I can tell you stories of things that happen just like what I said that we've seen. Make sure you have an organization chart because the buyers are all going to ask for it. Who is this employee, and not necessarily who, but what is their responsibility? And most importantly, what's the accountability? Are they doing their job properly? Are they not doing their job? How are you testing that? Okay. So next, we run your business today as if you are selling it tomorrow. Kelly, we're on the next slide if you can get there. So think as if you were a buyer and you say, okay, be sellable. What would you look for in a potential seller? And all the things that we're talking about are things that these buyers will look like. So you have to be what we've called seller ready. If you went to your bank to borrow funds for this transaction as a buyer, they're going to want to see all this information before they plunk down whatever amount of money necessary to loan to the buyer to buy somebody. Remember all the items that we discussed today. Of the items that we discussed, I have like some things that I think are like top hits. Number one, make sure that you have good sellable contracts. Jason went through this in detail. I'm saying it again. Also, your attrition rate. Every buyer looks at your attrition rate. And as Jason said, 10% or lower is great. higher than 10% is suspect. And the buyers will, look at that. And if it is higher, as Jason said again, even though they may want to buy the company, they may buy it but they're going to offer a lower price, or they may hold back more money in order to keep the transaction alive. And then the last thing is having a great management team. Here's some I call it fool's gold. Number one, a large percentage of your revenue should not be with only one subscriber. Again, I could tell you a story. It's 11:56. We're supposed to be over by noon, so I'm watching that. But there's stories about companies that we've worked with that 50% or more is with one company. Buyers don't like that. Your accounts, you may be proud of the fact that they're geographically scattered, but the buyers may want just your location. Products either shouldn't be obsolete or proprietary. You may be proud of the fact that you went to China or somewhere and got your own product line, so you then could pay less, charge less, and make more money than your competitor and win out some bids. When it comes to buying, the buyers are going to look at that and say, I don't like the fact that you've got a proprietary product line. Instead of doing all the sales yourself, again, build a great team, because they will do that. They will, and the team will do that. Customers, if you're saying the customers love me and they deal with me all the time, that's not a good thing either. So again, the team approach is much better. Benefiting from efficiencies. What are some of the key benefits of business efficiencies? One is you have to figure out how to lower your operating costs. That may be in getting a more effective software program. It may be just that you have old line processes that you need to, get the new stuff that's out there. There's great software programs that does a lot of things that people used to do, and now by a push of a button, you can get a lot of information. Again, business efficiencies would produce higher productivity. That would result in hopefully a better customer experience. You'll have a stronger competitive advantage that will mean that you will have increased profitability. And hopefully, because of all this high-tech stuff that you're doing for business efficiencies, your employee morale, your employees will love it. They like this stuff. And it goes for every division within your company. It goes from sales to marketing to technical to operations, management, finance, human resources, administration. Apply what I just said. In fact, how I learn about business efficiencies is just by looking it up. What makes for business efficiencies? So that's really it. And the above will create a more desirable earnings for a potential buyer. They will love it. And hence, more potential buyers will be looking at your company. That equals higher offers. That equals more money in your pocket. All good. And so from my end, that concludes what I have, and I'll turn it back to Kelly. It's noon.
Okay, I'm going to be really quick. Want to make sure you
Sorry.
know about the next webinar in 2 weeks. There is a QR code at the bottom of my screen. If you want to snap that real quick, that will take you right to the registration. We're going to be talking about your market, your brand, your growth strategies in 2 weeks, same time, same place, hopefully without so much issue with the slide sharing. All right, one last slide I'm going to just share with y'all right quick, and then we will wrap. But this is just our contact information. And if you'd like to connect with us on LinkedIn, hopefully you can see that. Are y'all able to see the slide with our contact info?
Yes.
Okay. All right. So please, if you would, connect with us on LinkedIn. If you've got any questions, feel free to send us an email. You can also send it through our friends at TPI. Thanks again, guys, for letting us share with you and for spending your time with us today. Have a wonderful rest of your day.
Thank you.
Thank you, everyone.